Why did Warren Buffett significantly increase his stake in Chevron? Well, welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Chevron is that it's now the third largest position in Berkshire Hathaway, Warren Buffett's company. This is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this is for informational purposes only. It's not investment advice or recommendation. So, first of all, when Warren Buffett acts, the world listens. Here's the headlines. Buffett is back with one of his biggest buying sprees in years, and Warren Buffett just made an even bigger bet on oil prices. So Buffett is bucking the woke ESG agenda, and he's overweighting a dirty industry. Naughty Buffett. Well, in the S&P 500, the energy sector makes up just 3.7%. In fact, people have been advocates and all kinds of people have been pushing down on the energy sector, particularly trying to force the energy companies not to do much capex. Buffett placed a heavy bet on energy. This investment in Chevron and Occidental Petroleum added up to about 10% of his total portfolio. This represents an energy, let's say, overallocation. If it's 3.7 neutral in S&P weighting, he's double that at 6.3. Investing in Chevron means betting on rising oil prices. There's been a 91% correlation between the company's stock price and crude oil prices over the past year. Hence, predicting the oil price will help to estimate Chevron's revenue. Clearly, Warren Buffett thinks oil prices are going to go up. Now, what's also interesting is that it's not like he bought this at when the stock was really bombed out, because you can look and see that the stock went below 100 back in July of 2021, and recently now it's up at about 160 or so. So how does the consensus view Chevron? Well, analysts are equally divided between buy and hold. Not that many strong buys and almost no sells or strong sells. Now, in the past few months, analysts constantly have been increasing their target price because of oil prices. Now, before I show you my valuation of Chevron, if you want to learn how to value companies like this, check out my 6-week online Valuation Masterclass Bootcamp. The next class starts on May 23rd. You'll learn practical stock valuation skills. You'll access tools, tips, and tricks. You'll join a group of inspiring, like-minded professionals, and you'll get a job through my network of thousands of financial industry leaders. You can join for just $797 until May 16th when the price goes up. Just scan this QR code to learn more, or go to valuationmasterclass.com/bootcamp. So let's take a look at my value model for the company. On the left-hand side, and I want to say hi to everybody. If you've got a question, feel free to put it into the chat. And I see Hillary there. Great to see you. And Hillary, I'm trying to improve a little bit of the way I'm presenting the company. So let me know how I do. All right. First thing is I want to look at revenue. Revenue's on line 14 here. I've highlighted it. And we can see that the company's revenue was down as low as 94 billion US dollars. That was in 2020. But then it went up to 155, and it looks like maybe more than 200 billion in revenue because of rising prices happening in 2022. Now, the first thing I want to do is look at that revenue growth. In fact, if you go back over time, you can see the revenue growth is very volatile. In 2019, it was minus 12. Then it was minus 33 in 2020. Then it was back up by 64% and up and down. This is a very cyclical type of business. Our estimate based upon oil price and demand is that the revenue is going to rise by about 40%. Now, if we were wrong, then we would say that revenue maybe isn't as high. And we can also see that the gross profit margin has been about 31%. That 31% gross profit margin is the highest it's been in a long time. So high oil prices mean very high margins. Now, on the right-hand side, you can see my rough estimate of the value of the company. First, we can see the chart showing current price is 167.6. The DDM valuation is only $74. Part of this is because the company's not paying out that much capital as dividends. The other thing, if we look at it, free cash flow to the firm and free cash flow to equity, and remember that these are going to be almost identical because the company doesn't have that much debt. Most of the energy companies have a heavy amount of paid up capital and retained earnings. So we can see that the value is about 185 to 192 if revenue grows by 40% this year and gross margin stays high at 31. But what if it doesn't? Let's bring down that revenue growth. Let's say the oil prices come down and over this year, instead of being up by 40%, revenue's up by 20%. That's going to basically bring down the share price on a free cash flow to the firm basis down to about 161.7. So here we can see that it really is this bet on oil prices rising much higher. Now, the second thing that we have to look at, so I've already put in a little bit of a pessimistic case here, a 20% revenue growth for 2022. Now let's look at gross profit margin. Basically, the gross profit margin, if I go back over time and I look at Chevron since 2013, I can see there has never been a time that it had its gross profit margin of 31% as it did in 2021. So we are at a peak of gross profit margin for the company. You can see that the average gross profit margin is about 28%. So in my forecast, what I've done is I've said 31% gross profit margin, and basically it stays the same for a while. But what if there's just more costs involved and they can't maintain their gross profit margin? Let's just bring it down to 28 and see what happens to the value estimate. We go from 31 down to 28 and we see, and let's just say that we maintain that 28 during the next 5 years. What we're going to see is that the value of this company is about 150 or so on free cash flow to the firm and about 170 on free cash flow to equity. So overall, what I would say is that when I look at this company and I go back, I'm going to go back now to my original forecast, and that's a 40% jump in revenue in 2022, and then a little bit of a fall and then flat forward period. Then I go back and say that they can maintain a gross margin of 31%. And let's say that they can hold that 31% for 2 years, and then it goes down to 30% after that. What we're going to see is the free cash flow value is about 186 and about 193 for free cash flow to equity. So what you can say is that based upon a pretty good recovery in oil price and also a stable high margin, remember margins at almost a peak, is going to tell you that this company, that Buffett's got a bit of a bargain. The question is, how is it going to play out over the longer term? Now, what you could argue, let's just do one last scenario. I'm going to go forward to 2023, 2024, 2025, and 2026. And let's say energy is, under so much pressure. They've stopped all this CapEx. But what have we seen in Germany? What we've seen in Germany is that the energy companies basically can't finance. So let's just discuss this for a second. What's happened in Germany is that there was a green demand revolution, political movement that's basically said we must go green. So they went renewables. But over a 10-year period, what we can see is that they were only able to slightly increase the energy output from renewables in Germany. And then they were cutting down their oil and gas and coal in Germany. And so Germany got into a difficult situation. And then all of a sudden, Russia is not going to be providing oil or gas and oil to Germany, or Germany's not going to buy it. Germany's in big trouble in that case. So let's think about that, number one, and Europe overall. Let's think about number two. The woke ESG crowd led by BlackRock, and the chairman and CEO of BlackRock has been saying we're not going to invest in any companies that are not ESG friendly. Okay, great. So what has happened to the oil and gas industry is that they have stopped doing CapEx. They have stopped expanding massively. Over the last 5 to 7 years, they've been under so much pressure that they've just put their money into renewables. But we know that renewables are not that profitable. Why do we know? Because they only exist in many cases because of government subsidy. So if the government subsidy wasn't there, they wouldn't be profitable. So there's a very serious issue here. And you could say that maybe Buffett is playing that issue. and saying that the world is not going to transition off of oil. Instead, they're going to be stuck on oil for a long time to come. Now, if that's the case, let's change the forecast just a little bit. I'm going to go into the revenue growth. And instead of saying it's going to come down and oil price is going to come down, I'm just going to say that revenues growth is going to grow by 20% every year for the next 3 or 4 years. We're going to see that the value of this company all of a sudden becomes $400 per share and $194 for the DDM method. Now, that's a little bit extreme, so I'm going to bring it down to 10% revenue growth every year after 2022. And here we can see that the value of the company is $300 compared to a current price of $167. Finally, let's be a little bit more realistic, and I'm going to bring down the gross profit margin a bit from 31 down to 30. And that's going to bring, in fact, we may even come down a little bit more. I'm going to come down to 29, and then I'm going to bring it down to 28. So we're back in line with the average. And what do we see? That the value of this company is about 280 or so US dollars per share. And in that case, Warren Buffett has got a pretty darn good deal. So that is the case of Warren Buffett's purchase of Chevron. I find it fascinating. I would say that he is making a bet against ESG. He is making a bet for oil and against renewables being able to replace the supply of oil that's being cut. And he's making a bet against the CapEx and basically saying that a lack of CapEx means that supply is going to be tight and oil prices are going to rise. So what you can see here, in fact, Kyle says it sounds similar to the meat and agriculture. Yeah, in fact, some people who are conspiracy theorists, I'm not one of them, but occasionally I can be. But some people say, hey, what's happening is that we're just getting elites that are putting pressure on food supplies, on energy supplies, and on access to US dollars. And when they do that, they're putting the whole world into a very difficult situation. Of course, the rich aren't going to mind that because they're rich. But for the rest of the people, we already see the problems that are happening in Egypt, that are happening in Kenya, in Nigeria, in Pakistan. All of these countries, Sri Lanka, are suffering deeply. Of course, the U.S. isn't going to suffer that much from all of it. Anyways, these are some thoughts about it. I'd love to have your comments in the and questions. I just want to recognize, first of all, Lee, good to see you. I would say that he thinks that oil price is going to rise. Hillary, great to see you as always. And let's just review. Ajit says, good morning. What's the terminal growth assumption? Oh, excellent question. Let's just check that 1 second. I'm going to go check that right now. My terminal growth assumption right now is 1%. So if I up that terminal growth assumption, it could be, I'm just going to do it right now. So I'm going to go into my model and I'm going to up that. So just let me show you where I'm doing that. This is for Ajit, who asked the question, terminal growth assumption. So here is my terminal growth assumption over on the right-hand side, and I've got it at 1%. Let's imagine that it goes to 3%. If it goes to 3%, the value of this company is 357. Wow. So it starts to look like maybe Warren Buffett made a very smart move. He's definitely making a move about oil prices. And I would say at a 3% terminal value, it still is a very attractive buy. Papa Benny says, hi, great to see you, Ben. Yeah, Hillary says, a woke black rock. Imagine that. And as Kyle said, it's similar to what we're seeing in meat and agriculture. And Lee says, I'm enjoying the sensitivity analysis. That's the fun of it once you got your model set. And Plun Pun says, why Oxy compared to other small? That's a good question, and I don't know the answer to Occidental. I must admit, I haven't looked at that one, but maybe that's what we need to look at next. And also, Abidun says, insightful analysis, I appreciate it. And also, Deval Jane says, good morning, good to see you. I appreciate all of your comments and all of your questions, please leave your opinions in the comments, and let's have a further discussion with it. It's Friday, 5 o'clock in Bangkok, Thailand. I wish you have a great Friday and an amazing, amazing weekend